Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang, and we are taking a look at bank earnings. OCBC kicking things off for the season for the banks, and they have reported a second quarter net profit of $1.82 billion. That's down 7% from a year ago as falling interest rates take a toll. The bank declared an interim dividend of 41 cents per share, which is slightly lower than last year's 44 cents. Net interest income slightly lower, 6%. And on a brighter note, non-interest income rose 5%. So let's check in now with Jane Mahmud. She is the senior analyst with Bloomberg Intelligence. Good morning, Sarah. How are you doing today?
Good morning. Good, thank you. Thank you very much for having me.
Great to have you on. So you're looking at earnings very closely for the banks. So let's start with your expectations. How did the numbers align with those expectations? Are we looking at a disappointment of sorts?
Even though profit was down 6% in the first 6 months of this year, it was still a beat of consensus expectations on stronger than expected non-interest income, chiefly led by the wealth management, demand, and also trading fees. And I think in many ways this does set the scene for DBS and UOB reporting next week, with slower profit generation likely on weaker net interest income gains, and also for those other two banks on potentially higher loan loss provisions to guard against asset quality slippage as the new trade war between the US and China continues to develop.
Okay, let's unpack a couple of these things. So let's start with the net interest margins, which is pretty much the profitability for these banks. We do expect lower rates in time to come. How much of a drag is this going to be for OCBC in the latest earnings and for the coming quarters?
Indeed, so OCBC's margin does remain under pressure, narrowing 12 basis points in just 3 months. And it could remain under pressure over coming quarters as loans continue to reprice downwards faster than deposits, and as the full impact of the Fed's 100 basis points of rate cuts from last year continues to trickle through. And I think we're likely to see OCBC close this year with margin around 1.9 to 1.95%, in line with revised down guidance from management. But that said, a slower pace of easing by the Fed could support the bank's profit margins for a little bit longer, and it does actually reduce immediate pressure to reprice loans and deposits. So while OCBC and peers, they do face fewer short-term margin headwinds now, especially after the hold a couple of days ago from the Fed, they do still need to be vigilant. So just by way of example, a 25 basis point movement in the Fed funds rate could impact OCBC's net interest income by around 125 million Singapore dollars. Now, after the decision from the Fed on Wednesday to hold rates, the market is still expecting 4 25 basis point rate cuts by the end of 2026, according to Bloomberg's World Interest Rate Probability. And according to our sensitivity analysis, this could shave about 6% off OCBC's pre-tax profit through 2026, which is a higher amount potentially than its peers.
So net interest margins, we are seeing that down 25 basis points to 1.98% in the latest quarter. So part of the equation is the loan demand or loan growth picture. What are you seeing now, or expecting at least, with the tariffs playing out, the trade tensions? We've been hearing how a lot of companies have been holding back on business plans. To what degree is that going to be a problem or concern for these banks?
So OCBC actually saw very positive lending activity, up 7% in a year, and this was led by the expansion of the bank's mortgage book and also higher non-trade related corporate demand. There could be a little bit of moderation in lending in coming quarters, with a slight slowdown after businesses obviously front-loaded their trade and their export activities in the second quarter ahead of the new tariffs kicking in today. But I do think that lending activity is likely to remain healthy, hovering around the mid-single digits this year. And also it's got to be remembered that OCBC is well placed to compete for cross-border businesses as supply chains potentially move into the Southeast Asia region, depending on tariff differentials. Now, longer term, this is very interesting. I think OCBC is likely to see significant opportunities arising out of the Johor Singapore Special Economic Zone, particularly around data center financing. And with a strong presence in Malaysia, which is about 12% of total revenue, almost on a par with its Greater China revenue, actually, OCBC is is well positioned to compete for business within the zone. And with a 19% tariff on Malaysia announced earlier today, down from 25%, we do see very strong growth prospects for the SEZ. And also in Singapore itself, with the building of Terminal 5 at Changi Airport, and also with the Marina Bay Sands expansion project, there is significant opportunity here that can help support the bank's loan book.
Right. You mentioned Greater China, so let's touch on that. Where does that fit into OCBC's growth picture? Because things like the US-China trade tensions and, of course, the structural issues of the economy are still playing out. Where does it fit in terms of outlook?
First of all, talking about asset quality, we could see some deterioration in OCBC's Greater China book on slower economic growth prospects, with bad debt in Greater China already accounting for over 35% of OCBC's total. But that said, OCBC's exposure to Hong Kong commercial real estate, for example, is relatively small, and the bank does tend to lend to premier developers, which does give rise to much more limited asset quality risk. Also, in Greater China, OCBC continues to scale up its wealth management business, adding relationship manager headcount, and also working on more sophisticated digital offerings to help clients navigate the current volatility and uncertainty in the market.
Okay, so we've been touching on the net interest margins and the income from that front. How about beyond that, where we look at wealth management? Where does it go from here?
It's very positive, actually. Wealth fees rose 31% compared with a year ago, and that was supported by a rise of just over 10% in banking wealth assets under management. And I do expect similarly strong performance from UOB and DBS when they report next week. I think demand for wealth services will likely stay strong for the rest of the year. And of course, as I just mentioned, OCBC does continue to expand its relationship management team, not just in Greater China, but also in Singapore too. Interestingly, OCBC is also expanding its wealth business in Europe, which is likely to capture more asset flows from wealthy individuals seeking to exit the UK after recent changes to the local tax regime over there for foreign residents.
All right, attracting flows from elsewhere. Taking a look at what is also on the radar is the dividends they have announced. It does look like they have reported an interim dividend of 41 cents per share, which is slightly lower than last year's 44 cents. What's your take on how this is playing out for OCBC and for the rest of the banks in the coming quarters?
Well, as for capital returns, OCBC still does plan to return around 2.5 billion Singapore dollars in capital to shareholders over the next 2 years, including a mix of special dividends and share buybacks. And it also does remain committed to a total dividend payout ratio of 60% this year and next year, which is higher than in previous years. Now, OCBC does have a stronger capital position than its peers, and this also could put the bank in a good position to embark on more M&A after integrating business units over in Indonesia.
Okay, lots to look forward to in the coming week as we get more numbers from UOB and DBS. And today we've been talking about OCBC's earnings with Sarah Jane Mahmud. She is the senior analyst for Bloomberg Intelligence. Sarah, thank you so much for your time. Have a great weekend in advance.
Thank you.
All right,
too.
Catch up with you again soon next time. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.